So first thing on the S&P 500 futures is I've pulled up an ATR, which is just the average true range, which gives us the range of price action on a specific time frame. This is a daily chart, and looking at the ATR, the average true range, we have seen a significant jump and a significant increase in the daily ranges of the S&P 500. In fact, today, the range currently, as I'm recording this video, is from 48.32 to a high of 52.86, giving us a 454 point range, and the market's only been open for 2 hours today. A 450 point range in 2 hours is a significant range, and this just validates the volatility that is obvious in the market. Versus Friday, we had a low of 50.74 and a high of 54.35, giving us a range of around 370 points. So we're seeing significantly larger ranges now, just zooming out to comparing what we were seeing a few months ago, even a few years ago, honestly. This range is significant, and it's not to be messed around with if you don't play defense or you don't know how to navigate these conditions. It's normal to not understand or never have experienced these conditions, and that's the point of this video, so you get a better understanding how to navigate it to find success and profits in these markets. Now, on top of the large ranges, we're getting large price swings, meaning from yesterday's close to the low, we were down 5.18%. So we were negative when the market gapped down yesterday at 6 p.m. Eastern time, minus 5%. We were opening up today's session only down 3%. The market opens up, we go back down another 5%, and then miraculously, from being negative 5% on the overall market, we were up 3.5% within an hour of the market being open. So that's a plus 8% price swing from the low of minus 5 to a high of plus 3.5. We've seen plus 8% price swings in a 1 hour period. It's just significant. It's just something that not a lot of traders have experienced. Honestly, even including myself, seeing a plus 8% swing in a 1 hour period is just insane to even talk about. And this is what I mean by ES is the new meme coin. There's a lot of money to be made if we time these swings correctly. It's just that we have to adapt and change with these swings. I've now pulled up a 5-minute candle, and from the low of the session around 48.70, in a 15-minute period, it went up to 50.14. That's over 140 points in 15 minutes. It's just unprecedented. It's something that is not normal in the market, but it is normal in these conditions. So when we're seeing this volatility, previous markets, a 50-point move was a full daily sessions range. Now we're seeing a 150-point move in 10, 15 minutes time. When the conditions change, we have to change with it. If we don't change with it and we stay stagnant, this is when a lot of traders will struggle to find successful trades, and they will find success in taking very poor, stupid losing trades that could have just been avoided. So with this in mind, it's very essential to approach the market with wider stop losses. And because we could have a wider stop loss, it's essential for us to have further out profit targets due to this volatility and due to this range. So it's normal. A normal stop loss for me used to be 3-5 points. Now a normal stop loss is 10-15 points. A normal target for me in previous market conditions were 15 points away, 20 points away. Now a normal target for me is 40, 50 points away, 60 points away. So now because of the increase in volatility, we have to adjust how we're confirming setups, and we have to adjust our risk according to how wide our stop loss is. So let's talk about this trade today that I took on ES future contracts. And again, this was 7 full-size ES contracts. And from my last exit, I got a 125 plus point profit, getting an 8-to-1 realized risk to reward ratio. Now, what happens here is the market was selling off into this level of market structure demand. I got plenty of videos on this on my channel of just a period of consolidation prior to a move up. Marked this as a level of market structure demand. And in the intraday commentary, this is just where I update my thoughts throughout the day of things that I'm watching, levels that I'm looking to develop, and trades that I'm looking to take. What I was watching for was the market to hold this 48.75 level of market structure demand to support the market for a bounce up into 49.15. It was about a 40-point buffer for a 40, 50-point rally to the upside as the market was supporting this just general range pretty much 3 times in the overnight session. So I was watching a bounce at this level. Now the market sells off, hits this level very well, and I confirmed this with the order flow of strong buyers down here, where I was able to get an entry long at 48.75. Now, if I'm long here at 48.75, my stop loss has to be at the low of day, which is around 48.66, 48.65, call it, which was about a 10-point stop loss. And as I mentioned earlier, a 10-point stop loss is a significantly higher stop loss than what I normally trade with. Now, because of this, my target and the ranges enables me to get a little bit of a further move, and where my 49.15 target came from was this previous high right here. So it was about a 40-point target for 10 points worth of risk, getting that planned 4-to-1 risk to reward ratio. Now the market bounces up and it fulfills the 49.15, and this is where I was a little bit of trade management, where I scaled out of this trade more than half when that target hit. Held some runners, which I will get into. But the point here is that my stop loss was significantly wider. Now, when you have a wider stop loss, you cannot approach the trade with the same trading size or the same position size that you normally would with a much tighter stop loss. Now, to visualize this, when our stop loss gets wider or tighter and our stop loss is dynamic, the stop loss is always placed where it invalidates our thesis. We have to adjust our position size to fit the current stop loss. Now, I just did this for micro ES future contracts because that's what I'm sure a lot of everybody watching this video trades. And let's just say we have a column at the top, which is our stop loss column. And the column to the left is our contract size or our position size. I've highlighted, let's just say our risk tolerance is around $300 per trade, which means we can only risk $300 per trade, and that's how much we're comfortable losing if our stop loss hits. Now, on a wider stop loss, let's just say on this specific trade I was trading with a 10-point stop loss like I was. This would enable me to trade with 6 contracts at a 10-point stop loss. Now, let's talk about previous conditions. Let's say my stop loss was normal and there wasn't much volatility and the market was didn't have a 400-point range like we're seeing right now. Maybe let's say the range was only $50 or 50 handles or 30 handles on a daily session. And my stop loss because of this could be very tight, only at 3 points. So my stop loss is only 3 points away. If I had my same risk of around $300, I technically could trade with 20 ES contracts with a 3-point stop loss, giving me a $300 loss. Now let's say the volatility goes to, we have ranges of 600-700 points, and now we have to widen our stop loss even more. Well, now if our stop loss is 30 points away, I technically could only trade this setup with 2 contracts because I'm maintaining the same risk. So you see how the dollar amount risk will maintain the same, but depending on the volatility and depending on how far my stop loss is that invalidates my thesis, my position size adjusts. And you could easily make this spreadsheet just depending on the instrument that you trade. It's just simple formulations of, I have $5 here for the micro ES contracts. I could simply trade this, put it to 50 and make this for ES contracts. So just adjust the size relative to your risk, and that will be crucial to adjusting to this volatility. And my trade today was 7 ES contracts with a 10-point stop loss, giving me an average risk of $3,500, which I just highlighted here. That is my average risk per trade, is between $3,500 and $4,500. And we can match it up here, $3,500 worth of risk. So I adjusted my size relative to this risk to fit it. Now, because of this volatility, hypothetically speaking, let's just say we shorted this rejection here of this pop into 51.08. As the market moves up into this level, we're looking to short this rally right here. Now, if I were to just say we get confirmation, this is a 1-minute chart. This 1-minute candle had a range of 40 points. Let's hypothetically speak, the high of this candle is at 51.08. If I were to get short, call it at 5,100 for say, let's just say, that would give me a 10-point stop loss, which means I need to get at least a 2-to-1 or better, which would be about a 20-point drop, which even on this 1-minute candle fulfills that. But the confirmations that I get in these conditions, I can't have a 2-3 point stop loss. By the time I confirm the setup, especially using the order flow, if I were to short that pop here into 5108, 5110, by the time I get confirmation and I see the selling comes in, it's much lower, around 5100. 5103, which then makes me have to put my stop loss above this high, which is a 10, 12, 8 point stop loss by the time I get confirmation. So the volatility is bringing moves that are happening a lot faster, and you have to think very, very quickly, or not even think, you have to act very quickly without putting much thought or emphasis into it while still maintaining the risk and clicking that buy or sell button on the blink of an eye. If you all want an in-depth video on like this risk management and my whole system behind it, just let me know. I could easily make that soon. Just let me know in the comments below. But a couple other things that I want to mention other than the position size, the risk, and the volatility is, well, here I held runners. So holding runners is a very good option. We're seeing the large ranges. So to me today felt a little bit like a gamble. I did not capitalize on this 10-10 news right here. I only capitalized on this rally, but the market never pulled back. It just kept going up and up and up. And truthfully, my target was at 49.14, but it blew past my target and I kept holding and holding and holding, and it worked out, but it felt like a gamble to me because the market just kept going up, and it was insane to me, and it just didn't make sense to sell and get away from this, I guess, moving train when I was on it in the right direction. So today felt a lot like a gamble, especially with the 10 o'clock news that came out. And there's a couple of points that I want to mention here. I'm going to pull up the pre-market plan. It's okay if the market does not make sense to you. If you cannot read the market, don't trade it. It's totally okay to not trade it. Truthfully, like when we have days like this, like I said, it's very easy to make money. And everybody will always talk about the wins, but not a lot of people will ever talk about the losses. You'll have some people that struggle severely on a day like today. Truthfully, you really will. And the ones who will make the most amount of noise are the people that are going to trade very well and make a lot of money very fast. There's always two sides to it. But the point I want to try to get here is that, especially if you're a beginner, it's okay to not trade the market if you don't understand what's going on, or you can't read it, or you really don't understand price action. If you cannot accept the risk and you're just not comfortable trading it, it's okay to sit on the sidelines and just watch the market. Like, that's totally fine. You'll learn a lot from that as well. So don't compare yourself to anybody trading this. Don't compare yourself to other people making a killing on it. You gain knowledge from experience, and I hope these videos do that for you all. But you will gain knowledge from sitting on your hands and watching the market, and just never ever compare yourself. The news that we saw at 10:10 was from a news source that said Trump is considering a 90-day pause in the tariffs, and later on the news source said that no one at the White House was aware of the news, and that's why kind of the market gave back its rally that it had on the news right there. And right now we're kind of trading sideways, and after this volatility and after this range, it's going to be a difficult session to trade, and that's why I'm recording this video, because I don't want to sit on my hands here or I don't want to not sit on my hands and force setups in this after I have already extracted the profit that I needed from the market from a great setup. So all this was a bounce at the level of demand at the low, and riding the momentum and riding the trend up, compensating for the volatility and accepting the risk, and understanding as well that if it doesn't make sense or you can't read the market, you don't have to trade it. Thursday and Friday, without those large ranges, I didn't make a trade. I didn't see anything. I wasn't comfortable with it. I didn't like the conditions. I was adjusting to it still. I didn't feel comfortable or confident because I wasn't so adjusted to it. Today, over the weekend, adjusted, compensated, and got rewarded from it. So, like I said, okay not to trade. Don't compare yourself. But if you gained any knowledge out of this, let me know in the comments below. If you're new to my channel, hit that subscribe button. And also check out the links in the description below. But I'm ending it. Peace out.